Hello and welcome to our latest edition of the Wescott Investment Series. I'm Mark McCarron, Wescott's Chief Investment Officer. And today, as usual, we're going to talk through a market and economic update that updates through today, June 5th, 2020. And we're also going to review Wescott's framework in terms of portfolio and perspectives and really focus on what actions you can take during market volatility. And then finally, we'll end with our current outlook. So first, let's get to the market update. Today, we got the U.S. unemployment rate figures, and in fact, the rate fell marginally to 13.3%. And that was unexpected. With all the lockdowns and closures, the expectation was that unemployment rate would be much, much higher as of May 2020 than it was. And the fact that it actually fell back down to 13.3% does suggest that things are getting a little bit better. That comes despite the fact that there's unrest across many U.S. cities that have, among other things, delayed planned reopenings of restaurants and stores. But as usual, the stock market is looking past the current risks. And I feel and we feel that the stock market strength that we've seen in the second quarter so far is based quite heavily on the fact that there's very, very strong fiscal and monetary response from the US government. And we have a little asterisk here, but a new research study by the Congressional Budget Office estimated that if the unemployment benefits were extended through January 2021, 5 out of 6 of those who are receiving those benefits would actually make more money from staying unemployed than going back to work. And that allows those who can't get back to work to at least participate in the economy and keeps things moving along. And I think that's really where the stock market strength is coming from. Just a quick update on that. This is a chart we've shown in many of our previous investment series. It's the S&P 500 index, this time updated through yesterday, June 4th. And it's been a very broad recovery in the second quarter. You can see that the decline was pretty significant, of course, in March, down 30% on the S&P and down 35 or 36% on the equal weighted S&P. But since then, there's been a very strong recovery in both benchmarks. And in fact, the year-to-date losses for the S&P 500 have been cut to minus 2.8%. And that's before today's markets, which opened up very, very strongly. And I think it does show and suggest that markets look beyond near-term risk. They are aware that there's unemployment at record high rates. They are aware, of course, that lockdowns and we're still in recession. The first quarter GDP was minus 5%, second quarter likely to be worse. But despite that, the bear market experience that we experienced in the first quarter, defined as a minus 20% decline, has already been erased. And that's been surprising to many. And we've talked about the reasons for that disconnect in prior communications. So one of the things we want to focus on today is what actions you can take during market volatility. And we have 4 actions we'd like to highlight. There are many more, but the first, and something that Wescott did early on in the crisis, in fact, happened at the end of last year prior to the crisis, but an emphasis on improving or allocating more to large companies versus small companies. Large companies tend to be more resilient and less sensitive to the economic cycle. And that brings us to the second point, allocating more toward companies that are defensive in their business models versus those that really depend on global growth accelerating. Those are economically sensitive. And those sectors, for example, are the energy or the airlines. Those are the ones that have been most impacted by the global lockdowns. But within those sectors, emphasizing companies that are strong in terms of their balance sheet strength, less debt, more cash, versus those that are weak or depend on the bond markets for their success. Then finally, within the fixed income market, some of the things to do to upgrade quality is to emphasize or allocate more to US government bonds and US Treasury bonds versus corporates who have that, again, that economic sensitivity depending on which sector you're investing in. So that's defense, upgrading quality. There's also some offense you can take by being more opportunistic. Sometimes market volatility brings prices way down below what companies' intrinsic value is or what they're really worth. And that's really because the market's very short term in that environment and not thinking about the long term. And it allows us to be a little bit more tactical within a strategic framework. So, meaning taking advantage of that disconnect. And we talked a little bit about this in our prior communications at the underlying manager level. We'll talk a little bit about what Wescott did at the strategic level on an opportunistic basis. The other thing we can do during market volatility is be tax smart, particularly for clients who are in the higher tax brackets and have a taxable account. Some of the losses you can take can be used to offset gains. So that's called tax loss harvesting. We were very active in doing that in the first quarter. What's really important, though, is that when you sell something to capture the loss to offset a future gain, you must replace that investment with something that looks very much like it, has the same general economic exposure. So that's what we mean by replacing like for like. That ensures that if there's a market recovery like we have seen, you're participating in that recovery even though you sold something in the midst of it. And making sure it's like for like allows us to maintain the portfolio's integrity. So what we don't want to do is change the nature of the portfolio from a tax loss selling standpoint. We want to maintain that strategy, that exposure, and those allocations going forward. And finally, we've had a lot of conversations with clients over the last month or two, really about their risk tolerance. And it's really important because periods like this don't happen very often. It's been 10 years since the last recession, and any volatility like this that we've seen is a test of resiliency for our clients. Because 10 years ago, maybe the volatility wouldn't be as damaging or as concerning, but 10 years later, maybe it is. So, and there's a behavior response, a belief or desire, to be able to sleep at night. Versus being overly aggressive. So really what we're talking about here is if there's a change in the stage of life 10 years later, is it still the right portfolio for you? And so those are the four actions we wanted to highlight, in two in particular being, one being a little bit more opportunistic. As we discussed early in March and April, there was an opportunity to take advantage of a disconnect, we thought, in the quality companies such as Apple, Microsoft, Amazon, Alphabet, and Intel, which are the top 5 components of the Invesco QQQ Trust, which is really representing 100 companies in the NASDAQ index. And with that massive sell-off, not only were economically sensitive companies selling off dramatically, but even those that are we deemed resilient and able to not only do well during this environment, but thrive going forward. And the price disconnect versus the intrinsic value was significant. So we added a QQQ to client portfolios in March 24th, 25th, that time frame. And we've seen a nice recovery since that investment over the last several weeks. So that's one example of being opportunistic when good quality companies sell off, providing an opportunity to generate that return. And that gives us an opportunity to invest in high quality companies whose intrinsic value we think is very strong, but whose prices are attractive, albeit for a very short period of time. So the other one of the 4 actions we can take is to reassess and review a risk tolerance. And just a reminder, Wescott has a range of portfolios that correspond to a certain investment objective, a certain risk capacity, and a certain risk tolerance. And the seven dots on this slide just show the seven different portfolios that we can offer across the risk spectrum. As you move from left to right, yes, the return expectations go up, but so does the expected risk of those portfolios. As we talked about already, if there is a change in the stage of life, or a change even in the risk tolerance or capacity to take risk, there is an opportunity to shift either down if you want to take some risk off the table, or up in risk if you want to take more of an opportunistic view. And maybe the thing I would end with in terms of the four actions you can take during periods of volatility, maybe the fifth one is calling your advisor. They are there to help sort of talk you through some of these strategies, the nuances in the portfolio, and ensure that you're lined up with the right portfolio for your particular situation. So finally, our outlook. We've talked about this many times, but I want to highlight again the accommodative economic policies, not only of the US, but we've heard recently from Europe and China are putting more money into their economies. This is what's supporting the market recovery so far in the second quarter. Then there's also that potential for an extension of more stimulus from Congress. And if that were to occur, that will provide even more support for the economy. That being said, we maintain our expectation for the U-shaped recovery, despite the fact there's been a V-shaped stock market rebound so far in the last 2 months. So with that, I want to thank you for joining us and your continued trust and confidence. As always, please don't hesitate to contact me directly or your advisor if you have any questions. Thank you.